Good day, my name is Dean Crocker. I'm an equity analyst with the PSG Wealth team, and today I'll be taking you through our latest EI report completed on Rio Tinto. So by way of an executive summary, Rio Tinto released their first half 21 results on the 28th of July. The results were significantly ahead of expectations. They reported substantially higher earnings, benefiting from higher commodity prices. Spot was trading at roughly $210, $215, whilst they realized a price of roughly $180. They then further benefited from sustained volumes, which allowed them to report substantially higher earnings. Free cash flow benefited from these earnings, resulting in a nice free cash flow of $10.2 billion. This allowed them to release a significantly higher ordinary dividend, which increased by 143% to 376 US cents, as well as declare a special dividend of 185 US cents per share. In terms of valuation, given that they are coming off such a high base, the EV/EBITDA basis does look quite cheap, trading at 31.8% discount to its 5-year average and a 14.2% discount to their FactSet peers. In terms of valuation, there's quite a bit of risk given that they are trading on a very high base, and thus growing from this base will be quite challenging. We've also seen a bit of pressure coming through on iron ore prices, and spot is currently trading in line with what their realized price was. However, we are mindful that they have had two additional months of higher prices. However, the group does still look cheap based on these valuation metrics. We are pleased with their high cash flow generation, which has allowed them to release pretty much all of their debt, and they are now sitting in a net cash position. And this should also sustain them releasing substantial dividends in the next period. The forward dividend yield trades at 11.5%, which is fantastic, and it gives you a nice portion of a buffer in terms of any downward movement. The group has no gearing, and they have a strong cash balance. As such, the business does still look very sound. It has a strong balance sheet with good prospects so long as the commodity prices remain really elevated in the sense. As such, we maintain our overweight recommendation. With regards to the event, as I mentioned on the 28th of July, they released their first half results, beating expectations across the board. Revenue was up by 71%, with underlying EBITDA up by 118% to $21.037 million. Free cash flow up to $10 billion, whilst the group declared a nice dividend as well as a strong special dividend. In terms of the impact, the market reacted seemingly inconsistent. The share price traded 0.79% lower relative to the Dow Jones, which was also lower. So there wasn't much movement. It does seem that the market has priced in these results to an extent. However, consensus is still below spot pricing if you were to calculate the EBITDA. Year-to-date, Rio has underperformed the benchmark by 5.4%, with a year-to-date return of 10.4%. However, since April 2021, the counter has underperformed the benchmark by 1.15%. That was our last recommendation. That's really inconsequential. With regards to the assessment, so the group's results are perfectly aligned with extremely favorable conditions. They are able to come to market with volumes and maintain those volumes whilst benefiting from substantially higher commodity prices. This has really driven their bottom line, but in such has also allowed them to reposition their balance sheet to be a lot more favorable. They're also able to take on debt in the future, but as such right now they are very cash flush. So they're able to manage and maintain any capex required whilst distributing excess earnings to shareholders, which we're very pleased about. There are some headwinds in terms of Mongolia and the Richards Bay terminal. Mongolia has some issues with regards to the new government which has come into power, and there's some discussions are taking place there. Whilst in Richards Bay, given that there were some safety concerns, they have closed their terminal until such a time. These are small, however, in comparison to the greater group. We are pleased that they're paying out the excess reserves rather than digging new holes, but there is some potential for pullback in iron prices, which we've actually seen in the last week, which could put a portion of headwind into to the group itself. Growing off such a high base, we do feel is going to be quite challenging. We would expect them to maintain the first half result performance going into the second half, which would imply that they can continue generating significant additional cash flows from which they can both grow the business as well as pay out distributions to shareholders. So we're cautiously optimistic. We have highlighted the potential risk around commodity prices, And should they decline by excess of 20%, we might reconsider or review our recommendation. But as such, right now, the group does still look extremely cheap. There are some concerns. We are acknowledging those concerns. However, given that there is going to be significant cash flow generation in the second half, we expect to see the continuation of dividends, and therefore have maintained our recommendation in that as an overweight. If you'd like to place a trade, please speak to your financial advisor.
Alternatively, please speak to the trading desk.
Please take note of the disclaimer and have a great day.